Secured credit cards. They exist specifically for people who are building credit from scratch or recovering from past financial damage. To open one, you deposit a sum of money with the bank, typically between $200 and $500, and that deposit becomes your credit limit. You spend against it like a normal card, and the bank reports your payment behavior to the credit bureaus. Used responsibly, a secured card gradually builds a credit history. After several months of consistent on-time payments, most issuers will either upgrade the account to an unsecured card or return the deposit entirely. Unsecured credit cards. These are the standard form most people think of when they picture a credit card. No deposit is required. The bank extends a credit limit based on your income, credit score, and financial history. You borrow, spend, and repay on a monthly cycle. Interest applies when the balance isn't paid in full. Unsecured cards vary enormously in their terms. Some carry high interest rates with minimal benefits. Others offer rewards, travel perks, or cashback depending on how the issuer has positioned them in the market. Rewards credit cards. Every purchase earns something back. The structure varies by card. Some return a flat percentage on all spending, others offer higher rates in specific categories like groceries, gas, or dining. The rewards accumulate as points, miles, or cash back, and can be redeemed in different ways depending on the program. Used correctly, a rewards card essentially offers a discount on everyday spending. The catch is that the math only works if the balance is paid in full each month. Carrying a balance means paying interest that quickly erases any reward earned. Travel credit cards. These are built around a specific kind of spender, someone who flies regularly, books hotels, and wants their spending to reduce the cost of future travel. Points or miles accumulate on purchases and can be redeemed for flights, upgrades, hotel stays, or transferred to airline and hotel loyalty programs. Many travel cards come with benefits that go beyond points: airport lounge access, travel insurance, no foreign transaction fees, and annual travel credits. The annual fees are often high, sometimes several $100s, but frequent travelers can extract value that far exceeds what they pay. Cashback credit cards. Instead of points or miles, spending earns a direct percentage returned as cash. The appeal is simplicity. No figuring out redemption values, no transfer partners, no expiration dates on rewards. Some cashback cards offer a flat rate on everything, typically 1 to 2%. Others use a tiered system where certain categories earn more. A small number rotate their bonus categories quarterly, requiring the cardholder to activate them to receive the higher rate. For people who find travel rewards programs complicated or simply prefer real money over abstract points, cashback cards are often the most practical choice. Balance transfer credit cards. Their primary function is to move existing debt from a high-interest card onto a new card offering a low or 0% introductory rate. If someone is carrying a balance at 20% interest, transferring it to a card with 0% for 18 months can save a meaningful amount in interest while allowing the debt to be paid down faster. There is usually a balance transfer fee of 3 to 5% of the amount moved. The strategy only works if the transferred balance is paid off before the promotional period ends, at which point the interest rate typically resets to a much higher standard rate. Student credit cards. These are designed for college students with limited or no credit history. The credit limits are low, the qualification requirements are more lenient than standard cards, and some come with small rewards on categories relevant to student spending: streaming services, dining, or bookstores. They serve as an entry point into credit, teaching basic habits around billing cycles, minimum payments, and interest. Some student cards automatically review the account after a period and increase the limit or upgrade the product if the cardholder has managed it well. The goal is to establish credit early without creating the conditions for serious debt. Business credit cards. They function similarly to personal cards but are structured around the needs of a business. Higher credit limits, expense tracking tools, the ability to issue employee cards with individual spending controls, and rewards categories oriented toward business spending: office supplies, travel, advertising, shipping. They also keep business expenses cleanly separated from personal finances, which simplifies accounting and tax preparation. Approval is typically based on the business's financial profile, and sometimes the owner's personal credit as well. Small business owners and freelancers often use these to manage cash flow between invoicing cycles. Store credit cards. Issued by retailers, these cards can usually only be used at the specific store or family of brands that issued them. The appeal is typically a discount on the first purchase or an ongoing rewards rate at that retailer that outperforms general cashback cards. The downsides are significant. Interest rates on store cards are among the highest of any card type, often exceeding 25 or even 30%. The rewards only have value if you shop at that specific retailer consistently. They can be useful for someone deeply loyal to one brand, but carry real risk for anyone who might carry a balance even briefly. Charge cards. Unlike credit cards, charge cards have no preset spending limit and require the full balance to be paid each month. There is no option to carry a balance and pay interest over time. That structure simply doesn't exist with a charge card. American Express has historically been the most well-known issuer of this type. Because spending is expected to be paid in full each cycle, charge cards appeal to high spenders who want flexibility without a fixed ceiling. The annual fees tend to be high, but so do the benefits, concierge services, premium travel perks, and elite status with hotel and airline programs. Prepaid cards. These are not credit cards in any meaningful sense, though they resemble them in appearance. Money is loaded onto the card in advance and spent down until the balance is gone. There is no credit extended, no interest charged, and no credit bureau reporting. They function essentially as a plastic version of cash. People use them for budgeting purposes, for giving to teenagers as spending money, or in situations where a card number is required but a bank account isn't available. Because they don't build credit and often carry loading fees or monthly maintenance costs, they offer limited long-term financial value. Chargeback protected cards. Most major credit cards come with built-in consumer protection that allows cardholders to dispute a charge if goods were not delivered, a service was not rendered, or fraud occurred. This is called a chargeback. It's not a card type by itself, but a feature so significant that it changes how people use credit cards relative to debit cards or cash. When a purchase goes wrong, a hotel that doesn't honor a reservation, a merchant that disappears after taking payment, the credit card company can reverse the charge while the dispute is investigated. For large or uncertain purchases, this protection alone is a compelling reason to pay by credit card rather than any other method.